to get started. Welcome to the Forecasting Your Financial Future workshop. Before we get started, I have a few notes on using Teams. The menu bar should be located at the top of the screen where you can find the chat icon to join today's conversation. To ask questions, type it into the chat box on the right side of your screen. I encourage you to keep this open throughout today's breakout. Today's workshop will be structured as follows. Manny will do a presentation on strategies for building wise financial plans, and then we will dedicate the second half to Q&A. You can start typing in your questions at any time. I will now turn it over to our moderator, Ciara Larkin, the Managing Editor of Small Business Product for Co.
Thanks, Hannah. Hi, everyone. As Hannah said, I'm Ciara Larkin. I'm Managing Editor for Co. And welcome to the Forecasting Your Financial Future workshop. Thank you for taking the time today to join us. I'm sure your days are super busy and we really appreciate you being here. These past several months have shown us that a strong financial plan is essential to the survival and success of a business. So we're going to spend this next hour talking about the things that business owners can do to forecast their finances and build effective plans. Throughout the workshop, you'll see the chat box. Please feel free to add your questions and comments into the chat as we go along. And that said, I'm happy to introduce Manny Cosme, who's the President and CEO of CFO Services Group, who will lead the discussion today. Take it away, Manny.
Well, hello, everyone. Thanks for having me here. Super glad to be here. This is my absolute favorite topic in the world to talk about. You know, I'm a little bit of an accounting nerd over here, so I always appreciate a platform where I can get on my soapbox and talk about why everyone needs to have good financial projections for their businesses. This is all about making sure that you can really grow your business and achieve the success that you want out of your business. So happy to be here. I'm going to go ahead and share my slide deck here because, you know, I always like to have slides to go along with what I'm saying here so you don't just, you know, hear a talking head or anything. So give me one quick second. Let me load up my slide deck here. Let's see. There we are. Perfect. 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 All right. So hopefully everyone can see this here. Hopefully you see a big thing that says create a financial business plan, financial projections 101 on your screen. If you can't, let me know, I guess. But that's what we're here to talk about today. So creating a financial projections are absolutely vital to the success of your business. Your financial projections really serve as a roadmap showing you where you are today and where you're going to go tomorrow and how you're going to get there. So how are you going to get from point A to point B? So this presentation will explore the steps that you're going to take to actually create that plan for yourself. You're going to define your sales goals, build out your costs. What is it going to cost for you to get there? What does your cash flow look like? Kind of really important things like that. So that's what we're talking about here today. Sorry, let me do something real quick before, yes, okay, perfect. Just want to make sure that my voiceover doesn't start happening here. Okay, perfect. So some learning objectives we want to do today. Always like to leave you with some objectives. We're going to talk about the 5 steps to creating your financial projections. Obviously, that's the big one here. We're going to talk a little bit about forecasting your sales and your cash flow. How do you do that? Discovering what it really costs for you to produce and sell your products and services. And identifying potential cash shortfalls and what you can do about them now so that they don't actually happen, and a few other things here. So again, my name is Manny Cosme. I am the founder and CEO of CFO Services Group. We are a management accounting firm, which means that we focus on 2 things. We focus on bookkeeping and the back-end office accounting functions. And then we focus on financial strategy. So those are the 2 areas that we focus on. It's all about managing your money to make sure that you're making good decisions in your business, again, to be able to move forward and grow. I personally have been in this industry for over 20 years, helping small businesses and small nonprofits manage their finances. And so I'm, again, always happy to talk about it here. But I don't just do accounting. I also run a business myself. So I am, as I like to tell my clients and you all, I'm in the trenches with you, really running my business day to day as well, and making sure I'm making good strategic decisions in there. So I absolutely identify with any of the potential issues and obstacles that you all are facing. So, I kind of lean on that as I do these presentations as well. I always think, what would I like to know if I'm on the other end here watching this presentation? What would I need to learn in order to help me move my business forward? That's kind of the philosophy I use when I do these presentations. So with that, let's start with a staggering statistic. So according to Intuit, who are the makers of QuickBooks, hopefully you know what QuickBooks is, 20% of small businesses will fail in their first year. So that's 1 in 5 businesses will fail. And half of businesses actually never make it past their 5th year of business, which is insane to me. But if you work with an accountant, then your odds of success increase by 89%. All right, so the message is clear here. Working with an accountant means that you'll have good financial records, and good financial records will help you answer important questions in your business that will ultimately help you to avoid trouble and keep growing your business. All right, so in the world of business, this process of setting up your destination and planning the logistics and whatnot is encapsulated by what we call a business plan. So hopefully you all are familiar with what a business plan is. It does exactly what the name suggests. It plans the growth of your business. So it clearly outlines, like things like your milestones that your business wants to hit, your sales and marketing strategies, competitor analysis, product and service descriptions, and the financial projection. The financial projection, which is at the very bottom of that triangle there, and it's there for a reason, is because the financial projection, in my opinion, is the most important part of your business plan, because what it does is it translates all of those subjective thoughts that you have up there, milestones, strategies, things. It distills all of that subjectiveness down into actual concrete plans in dollars and cents that you're going to be able to do as you move your business through time, okay? So in other words, I like to say it translates all your thoughts and ideas into reality is really what it does. And then it forms the foundation for the rest of your business plan. So what is a set of financial projections? What does it do in technically, okay? So a set of financial projections does 4 things really, okay? 4 main things. 1, it shows you what products and services your business will sell at the price and the quantity that you plan to sell them at. Price being very, very important. Okay, how much are you going to sell it for? How much of it are you going to sell? Okay, 2, it shows what resources you're going to need in order to make these sales. So for example, do you need to buy raw materials? Who do you need to hire? How many locations do you need for your business? Things like that. Okay, 3, it shows how much cash the business will need in order to achieve these goals. Are you going to have enough cash? Or are you going to have a shortfall? What are you going to do about it? Very, very important, right? And then number 4, it shows all of this as the business moves through time. So if the business currently sells 2 products, for example, when is it going to roll out the 3rd product? When does the next employee need to be hired so that you can expand operational capacity? How long can the business sustain itself before it needs to borrow money? So as you can see, as a business owner, or if you run a nonprofit, same thing, you have to answer these crucial questions if you're going to really ensure that your business is a success, right? So the financial projection really is, in essence, your business plan, because it really does tell you how you're going to move your business step by step, month by month, year by year, as you start to achieve your goals, all right? So this presentation is going to show you the 5-step method to building a solid set of financial projections that you can use to plan and grow your business. So we're going to walk through each of these steps here and explain each one. So pay close attention so that you can understand how to build the growth of your business. Okay. Now, if your business has been in existence for a bit, then good for you, because you're going to have a really nice foundation with which to start building your projections. You're going to have some data that you can rely on to kind of see what's been going on, and then hopefully use that past data to predict your future. Now, if you're a brand new business, You may not have that data, and that's perfectly okay. You can still do financial projections. I get that question a lot. You can still, in fact, I encourage you to still create financial projections based on what you think the business is going to be doing and your knowledge at this point. The thing with financial projections is they are always changing. You should always be updating your financial projections at least once a month. Okay, so that you have the latest and greatest information, especially with small business, things are changing all the time. So if you have historical records, that's fantastic. Make sure that you grab them and use them here. And if not, then we'll just start estimating stuff. And then over time, we'll see how good your estimates are. All right. Now, another question I get a lot is, do I have to have any special software to create a set of financial projections? And the answer is no. In fact, I prefer that you create your projections using a simple spreadsheet program like Excel or Google Sheets, because you can really get hands in there and really understand how your business is moving. Yes, it's great to have someone prepare a set of financial projections for you, but it's so much more powerful if you can get your hands in there and really work with your information to really plan out your business. It's so, so, so powerful. So that's what I'm going to show you here, is how to create financial projections just using a simple spreadsheet. All right. So fire up your spreadsheet and follow along, if you will. So we're going to use a fictitious business as an example here, as a case study to help us illustrate how to create financial projections. So meet Bob. Bob is the owner of Bob's Burger Joint, okay, a small casual dining restaurant. And he sells three things. He sells burgers, hot dogs, and ice cream. He also does catering projects for small events. And he also has a meal subscription plan where customers can subscribe to receive takeout food on a regular basis, all right? So Bob has hired us to help him create his financial projections so we can help him grow his business. So we're going to use that on our journey here to illustrate how to create financial projections. All right, so with that, let's go ahead and move on to step one, which is how to forecast sales. All right, predicting how much sales you're going to have. So now I know what you're thinking, big question mark. How can I possibly predict what people will buy from me? All right, it's a fair question. It's easy to predict your expenses because you can control that for the most part, right? You can control how much you're spending and whatnot, you know, generally for the most part. But you can't really control who, what, or how much people will buy from you, right? It's a little harder to do that. Yet predicting your sales is of vital importance, because everything else in your business flows from the sale. All right, so let's illustrate that. So think about it. The amount of customers that you have will ultimately determine how much resources you need in your business to fulfill the sales that they're driving, right? It'll determine how much employees you have, how much materials you need to have, what kind of office space or factory or whatever, you know, retail space you need to have. So everything starts from sales. So the very first thing we need to do if we're going to project our business and build our business plan is to determine our sales. Okay, we need to determine what that's going to look like before we can move on to anything else. So predicting sales, it involves predicting two things really. So one, sales volume, right? So how much of the thing I'm selling will be sold, so quantity, right? So volume. And then B, the dollar value per sale. So how much money do I get for each one of these things that I sell, okay? Then you simply multiply the two together and you get total sales, right? So that's pretty simple formula there. But you need to know volume and you need to know price. So the big question is, how do we figure this out? So luckily, there are some methodologies that you can use to predict sales and dollar volume. So if you use a customer relation management software program, for example, that has a sales pipeline feature, it will become much easier for you to predict your future sales. So if you're in an industry where you have a pipeline of sales coming in, I highly recommend that you use a sales pipeline system, like a CRM system, to be able to track what you're selling. So you want to track things like how many prospects come in, how long does it take for them to move through the pipeline, what's the average dollar volume of the sale that they're bringing me. If you start tracking that, eventually over time, what you're going to do is you're going to start finding some trends. I promise you, because it happens every single time. We start finding trends in your sales. Maybe it has seasonality to it, or maybe you start building up a momentum and you can start predicting month over month how many sales you can anticipate coming in the door. And so we can use that data from your past sales, to then start predicting what your future sales are going to look like. Okay. So that's a very big topic. Of course, we can probably spend an entire hour just talking about how to predict sales in that forecast. If you're interested in that, please reach out to me. I'm happy to have a conversation with you about that. But that's one way that you can use to predict sales. Obviously, if you're in a more of a retail space, then you want to look at your past sales data, like from your POS system and whatnot, and that'll help you predict sales as well. Okay, so that's a couple of methodologies that you can use to forecast your sales. Okay, so if you don't have a sales pipeline, you don't have that data, then all is not lost. Of course, you can still predict your sales with some accuracy. What you want to do is look at your past sales history and then use that again to predict your future sales. So again, lots and lots to dive into in this particular area. But generally, what you want to do is kind of do something like this. So start by taking an average of your last few months of sales, which then become the baseline for your future sales. And then what you want to do is adjust your sales based on any changes that you're anticipating that you're going to make in your business. For example, are you going to be increasing your prices this year? That's a big one, right? Or are you going to be looking at increasing your volume by hiring a salesperson or ramping up marketing or things like that? So think about some of the changes you're going to make in your business, and then you can throttle your sales up accordingly based on that. Okay, and then that becomes a projection of what you can reasonably expect your future sales to look like. So this last point is important because if you're trying to be, especially if you're trying to grow your business, there are only two ways that you can really grow your sales if you think about it. You can either increase the prices that you charge to your customers, or you can increase the volume of the product or service that you sell to your customers. So your job as the owner of your business is to determine which strategy or mix of strategies is going to work best for you in your unique circumstances. So some things to think about. If you want to increase your prices, then here's a couple of things to think about. What's the time frame for rolling out your new prices? For example, will you start charging new customers first and then slowly back into your existing customers with the new prices? Will some existing customers leave you if you increase your prices? And then that's going to decrease your volume. And how many of them will leave, and so on. So think about these changes, and then make sure when you start projecting your future sales forecast that you consider these when doing your forecasting. If you're going to change your volume, if you want to basically increase your volume of sales, okay, some things for you to think about there. Instead of increasing your prices, you could actually decrease your prices, which tend to have a positive increase on volume, and that will give you more quantity and therefore hopefully more overall sales potentially.
Okay. Hey, Manny.
Yeah.
I have a quick question, and you might get to this. So if you are going to get to this, just tell me to hold my horses. But
yeah, totally.
I'm wondering, when it comes to the sales predictions, if you're a brand new business and you don't have sales to analyze, what do you do?
Yeah, no, that's really great. That's definitely a much trickier. I mean, let's be honest. If you don't have past data to look at, it can be tricky. What we tend to do with new businesses is we look to see if there's someone else in the market and try to basically guesstimate what they're doing volume-wise, which again can be very difficult. But honestly, for a new business, it is hard. So the more important thing is to just kind of do your best guesstimate as to what you think your sales are going to be. That's number one. Then number two, start monitoring it like every day. Every day go in, monitor your sales, and literally update your projections. When you have a new business, you should be updating your sales forecast on a regular basis, probably at least once a week. You want to update them because you're going to be getting new information all the time. Now, over time, if you have a business for 3-4 years, much easier to predict your sales. So it's not, the best answer, but honestly, that's the way that we do it, is we have to really just kind of test it and see how it goes. Yeah.
Gotcha. Thank you.
Yeah. No, that's a great question though. Yeah. Great question. So, volume. So you can increase your volume. You can also hire a salesperson here, and that's another way that you can increase your volume or increase marketing and whatnot. So just some considerations there on how you're going to increase, but you have to generally do one of those two things, you know, increase your price or increase your quantity if you're going to increase your overall sales. All right. So let's go to our case study and help Bob forecast his sales. So we start by looking at Bob's sales. So we look in his POS system and we see that Bob has sold an average of 800 burgers per month, 900 hot dogs, 600 ice cream cones, and 4 meal subscriptions per month. All right. And he's not doing any catering projects. So this is where we start. This is his historical sales over the past 12 months, let's say. Okay. On average per month, this is what he's doing. So this is our baseline here. Now, Bob is looking to grow this year, so he's going to look to be increasing his sales by hiring a marketing firm to advertise his products on TV and radio. And he's also going to hire a salesperson to get catering projects in the door. And he's going to be increasing his prices on burgers and dogs. All right, so what he does is now he plots out how these changes are going to occur month by month as he moves through the next few months. Your business is constantly moving forward, and it's important that you track in detail how the changes you make in your business will affect your sales of your products and services by each product and service line and month by month. All right, super important. So let me show you what that looks like. So let's start with the burger sales. What we're going to do is we're going to do a projection for everything that he sells. So we're going to start with burgers. So here's the burgers, and then month by month as he moves through the year, how many burgers do we think he's going to sell in that month? What's the price he's going to charge per burger? And that's going to give us the total sales by month. I highly recommend that when you do sales projections, you do them month by month by month. It will be helpful for your brain to wrap. It'll be easier for your brain to wrap your mind around that, basically, if you do it a monthly projection. So you can see here that we're increasing the volume because we're doing some marketing. So we expect a natural increase in the volume. And in March, we're increasing our price. So you can see that now, based on those two things, we expect more and more sales as we move through the year. So we do that with the burgers. We also do that with the catering projects. So here's catering projects. And remember, we hired a salesperson. So maybe around March, they start really kicking in. And now they're getting us one new project a month, let's say. All right. So month by month, we're starting to increase our sales volume on the catering sales. And that's kind of how we go here. And it continues on with all the other products and services that he sells. All right. So when he's done doing this exercise, we're now going to throw this into our spreadsheet. And this is what it's going to look like. So let me pause for a second. Don't freak out. Don't worry. I know it's a lot of data and whatnot. It's actually really, really simple to read. So let me show you, this is what a sales projection ultimately looks like. So let me kind of walk you through this. Over here on your left-hand side, and you can see this is just built in an Excel spreadsheet. Over on the left-hand side, we see all the products and services that he's selling, catering projects, burgers, hot dogs, okay? And then we put a couple data points, numbers sold, average sales price, total sales. Very, very simple data here we're putting in there. All right, so that's on the left-hand side. Over here is where all the data is then, right? So line by line, how many did you sell? What's the price you sold it at? You multiply those two together and you get sales. So very simple math here, but very, very powerful. All right, and we're doing it month by month by month, as you can see here. And so ultimately at the very end, we get to total sales for the year. And now we can see month by month what Bob is predicting as his sales as he moves through the year. All right, so as you can see, Bob now has a plan for how the growth of his business will occur. And guess what? He has also set goals with which he can measure his growth against. So it's not like, well, we're just going to grow and, we want to make a few more sales. No, he has a specific plan here. He wants to hit $453,450 in sales by the end of the year. That is his plan. And he can monitor that month by month now to make sure that he is on point hitting his goals here. So this is the power of creating a financial projection. He now has a plan. a plan of action that he can work against. All right. So that's step one, is creating the sales forecast. I will tell you that takes the longest part of doing a forecast. It's the sales. It's the most intrinsic, difficult part of doing that, but it is the best, most powerful part of the sales projection, of the financial projection. All right. So any questions? I guess I should pause and see. No? All right, cool. Okay, I'll just keep talking. So, all right. So now we'll move on to step two, which is forecasting our expenses, really. All right. So forecasting our sales does not come for free. Obviously, as the saying goes, it takes money to make money, right? So we need to understand exactly what it's going to cost for us to fulfill the sales that we're now making. So in the world of business, we split our expenses into two major buckets. The first bucket are what we call direct costs, and those are the costs we'll incur to produce our product. So we typically call these cost of sales or cost of goods sold. You may have heard that term before. The second bucket are the indirect expenses that we incur to keep the business itself running. So we call those GSA expenses, or general sales and administrative expenses, GSA expenses. That's what we typically call that, or your overhead, right? So we're gonna split them into two. Let's talk about the direct costs first, and then we'll circle back to the GSA overhead expenses, essentially, in our next section here. All right, so there are three types of direct costs associated with the production of sales. So again, you have to spend money to make money, right? I sold this thing, I sold a burger, so now I need to produce the burger that I just sold, right? So there's three types of costs generally that we think about: labor costs, resale inventory costs, and raw materials. So labor is the amount paid to people who help you deliver your product or service. They can be employees, they can be contractors, whatever, but it's people basically that we're paying here. Okay, resale inventory. If I buy something and turn around and mark it up and sell it, that's my inventory. So that's resale inventory. Obviously, I have to pay for that at wholesale first. And then raw material is the stuff I buy and then do some work to convert it into the final good that I then sell out into the world. All right, so those are the three general types of costs that we see in small businesses. All right, now, a general rule of thumb here with direct costs is that they will increase as your sales increase. So in other words, the more you sell, the more cost you will typically incur, right? It makes sense because you have to pay to fulfill your sales. So the more you sell, the more input it's going to need in order to produce more things that you can sell, right? So whether it's purchasing more raw materials or paying someone to deliver the service or whatever. So that's, again, another reason why we need to first predict our sales before we can predict our direct cost. We need to know how much in sales we're going to have before we know how much input we're going to need to fulfill the sale. This happens a lot in hiring, by the way. Before we go and hire anyone, we need to know, well, do I need to hire someone? Well, to answer that question, I need to know, well, what am I going to sell? Because if I hit capacity and I can't fulfill that sale anymore, that's when I need to hire someone. But that starts with the sales forecast. So sales will tell you when to hire and whatnot, okay? So again, we need to do our sales forecast first, and then we can do our cost forecasting here. Hopefully that makes sense to everyone. All right, so, so let's go back to Bob here. So Bob needs a few costs to fulfill his sales. He needs to buy beef to turn into burgers and hot dogs. He upsells the ice cream, so he buys that at retail and then sells it. He buys it at wholesale and then sells it. And then he needs to hire a line cook to prep the meals. Okay, so we list each of these out and the cost per unit for each of these inputs. So here we are on the screen here. And then next, we need to figure out how much of the input he needs to make a sale. So each burger and dog requires a quarter pound of beef, which means it takes Bob $2.50 to produce a burger or a hot dog there. Okay, so very simple math there. Same analysis with the ice cream, and it comes out to $2 per serving of ice cream. All right, so that's pretty simple there, but obviously, again, very, very important to kind of go through that exercise. So if Bob's going to produce 1,000 burgers and hot dogs this month, it's going to cost him $2,500 in raw beef. And if he's going to sell 500 servings of ice cream, it's going to cost him $1,000 this month. All right. Now, notice I haven't talked about the line cook yet. So let's talk about that. So finally, we look at the line cook. So with human labor, we need to analyze this a little bit differently. And this is where people sometimes get tripped up. We need to look at the natural capacity for the person to produce the work. All right. And since a lot of labor is paid a flat salary or an hourly rate, no matter what they produce, we can't really look at the cost per product they're producing, because you can't get a quarter of a person. That just right, doesn't exist. Right. You have to hire the whole person. So instead, we can't do that with people. Instead, we look at capacity limits. So in other words, when does my current team hit their capacity and I need to hire the next person? That's the question we need to answer when it comes to people. So in this case, we'll look at how many things a cook can reasonably prepare within a month's time. So Bob's been studying the ability of his cooks, and he finds out that they can make an average of 65 burgers and hot dogs per day, or 2,000 per month. That's their capacity. They can do 2,000 per month. So this means that when Bob forecasts that he will sell more than 2,000 burgers or hot dogs in a month, then he needs to hire another line cook. That becomes the trigger to hiring the next person. All right, so hopefully that makes sense to everyone, but that's super important to understand when you're thinking about hiring people. All right, so we go through, we do all the analysis for the direct costs, all right? And when we're done, now we're gonna build out the next section of the projection. So we're building right from sales, we're moving right into costs here. All right, so just like that, we're gonna look at the total costs of the materials, right? The beef and the ice cream. So again, how much is he selling? What's the quantity of sale he's projecting? And then what does that mean in terms of material that he needs based on that sale? And then we can figure out the estimated cost. So again, very simple calculations there, but it all flows from the sales. Knowing your sales, then you project the cost. Okay, next we do the labor. Again, when he starts to sell more than 2,000 per month, now we know we need to hire that next person. So if you can look here, you can see April, it goes from one person, 2 people right there, because now he's selling more than 2,000 in that month. So now we hire the next person.
Hey, Manny.
Yeah.
We had a participant ask what happens if you don't hit your goals for the projections.
Oh, well, create new goals. No, no, I'm just kidding. Well, maybe your goals are unrealistic. That's always a good look. You set your goals at the end of the day. So it's you to measure yourself again. Well, maybe sometimes you have other people set goals for you. I don't know. But, that's your measurement. It's just a measuring stick to see kind of where I'm at. Where did I think I was going to be? So maybe you need to revise your goals, or maybe you realize maybe I need to work harder to hit those goals. I mean, there can be a lot of reasons. That's where a good business coach comes in. I will say that. So I will defer that over to the business coaches out there to help you figure out your goals. But yeah, in the world of projections, we just want to make sure that we are keeping on top of it, so we understand what all these inputs are so that we can adjust our business. That's what I'm looking at here. So yeah.
Gotcha. Thank you.
No, it's a great question. No, it's a great question. So now, based on all of that, now we have our total costs that we're going to incur based on our sales. So now you can start seeing, hopefully, the power of these projections. We know how much money we're going to make, and we start to understand how much money we're going to spend. Now we can start formulating in our head, okay, this is what I'm going to need. I see how my business is going to grow now. So we can really start putting this together. So that brings us to step 3. Which is forecasting our indirect expenses, or what I call the GSA expenses, so the general sales administrative expenses. All right, so these come in 3 different types. So we have sales and marketing expenses, which are related to the growth of the company, acquiring new business and building the brand reputation of the company, of course. We have management, which is all about, the management of the business. So this is not your frontline managers, by the way. It's not like the person who's managing the line cooks in our example. This is executive management. So most likely, if you're a small business, this is you, pretty much. When you put on your CEO hat, this is your cost. And related expenses. So things like if you get a coach, like a business coach, or you're getting some specific education around running a business strategy and whatnot. Okay, these are those expenses, management. And then finally, we have general overhead and administration, which is essentially all the other back office stuff you need. So think of office rent, insurance, legal, telephone, accounting fees, hopefully, okay, you need accountants, internet, et cetera, et cetera, et cetera, okay? So these are all the other things that go into making the engine of your business run, all right? And they're essential to making sure that you have a well-run business, all right? So those are the three basic buckets that we think about there. So let's pause for a quick moment and discuss a concept called fixed versus variable. You may have heard this before. If you've ever gone to a accounting 101 course or a business 101 course or whatever, you probably have heard this and you're like, oh yeah, I know what that is. But very important to think about. So in the last in the last step, when we worked on our direct costs, almost all of them were what we consider variable in nature. That means that as we projected an increase in sales, we also projected an increase in direct costs. In other words, as your sales changed, so did your costs change, okay? So increase in sales, increase in costs. That's variable. Conversely, with variable costs, when your sales decrease, then your costs will also decrease as well, okay? So that's what we call variable costs. They depend and change on sales. But not all of your costs or expenses will be variable in your business. Some of them will be fixed in nature. So when your costs or expenses are fixed, that means that they don't change even as sales change. They remain the same. So a perfect example of this is office rent. My office rent is the same no matter what sales volume I have, right? Especially if I signed a 24-month lease on my office, it doesn't matter. My cost is going to be the same month over month over month, no matter what my sales volume is. That's important because as we go about projecting your costs and your expenses here, you have to recognize which of them are fixed and which of them are variable. So again, you can accurately predict which will increase and decrease as you play around with your sales projections, right? So as my sales increase, do I expect this cost to increase or stay the same? That's what we want to look at here. Okay, so for Bob's Burger Joint, we've spent some time identifying each of the indirect expenses into their classification. So we have sales and marketing, we have management, and we have overhead. So we put some of these in these buckets here. So advertising, consulting firm, obviously, okay, executive coach, accounting, insurance is overhead. All right, so we bucket them into their buckets. And then we also categorize them by fixed versus variable. So this will help us as we go to our next step in how we expect these expenses to change as our sales increase. Okay, so we're going to stick them into our spreadsheet here, and we're going to split this into three sections. So sales and marketing, we've now identified them. We can see some of these costs are fixed, like our marketing consulting firm. That's a fixed fee per month here, month after month after month. Okay, advertising maybe increases a little bit, and et cetera, et cetera. So we lay them all out. Again, month by month, what do I expect this expense to look like? Very, very important there. Then we do the management expenses, and then we do the other overhead expenses. And then now we get to our total GSA expenses. So this is now what we're going to incur for overhead, GSA expenses here. And now we have our sales, our direct costs, and our indirect expenses. We can finally calculate our net profit, right? So net profit equals sales minus direct costs minus indirect expenses. And there we go with net profit. And now we add that, and now we have a very clear indication as to what we expect our profit is going to be for the year. Okay, or in this case, a loss, I guess. But now we can project at least what we can anticipate what that's going to look like. So I hope you all recognize how powerful that is for you to know as a business owner. You now have an understanding as to what your business is going to look like month by month by month. Nothing should come to you as a surprise in your business. Certainly over time, as you really grow your business and you're manipulating this information and updating it, I always say nothing should really come to you as a surprise in your business. You should be well prepared to handle any situation. Any questions, by the way, so far?
Yeah, we do have a couple of questions if you're ready for them.
Yeah, go for it. I mean, I have a couple more things, but we'll move on to cash next, but go for it.
All right, yeah, we can, take turns.
Okay, go for it.
So Stacy actually asked a question that I too was going to ask you. She is curious to know how she will know when she needs an accountant, or if she needs an accountant, and I guess there's all different types too. Like you can hire someone for part-time bookkeeping, all the way through to hiring someone for, a regular full-time accountant or CFO. So how do business owners know exactly what they need and when they need it?
Yeah, that's a great question. I get that question all the time. Well, my biased answer is you need an accountant from day one, of course. But I will say, to your point, there are actually 3 types of accountants in the world. So kind of think about it this way. You have your tax accountants, and that's typically when someone says, I have a CPA, that's typically what you're referring to as a tax accountant. So they're good at doing taxes, but a tax accountant is not going to help you manage your money. Okay, that's someone else. That's a management accountant. That's what I do. That's my specialty, is helping businesses think about how to spend their money and think about how to strategize to grow their business. All right, so a tax accountant is not going to do your management, and your management accountant is not going to do your taxes. I don't do taxes. I hate taxes. So 2 different people. And then when you get to a certain size, then you have your 3rd type of accountant, which is your compliance or your auditor, basically. And then what they do, their job is to make sure that all the information you're reporting out to the public, like if you have investors and whatnot, is accurate. Or nonprofits, of course, have to report out to the public. So if you're a nonprofit, or if you're a certain size and have investors, then you need an auditor to double check. They're like the police of accounting, if you will. But for small businesses, you're looking at management accountants and tax accountants, and you need both. And you need both right from the beginning, I will say. Obviously, you need to pay your taxes right away. So check the box there. And you also need to start setting up good bookkeeping systems from day one, because, well, this is one of the reasons why you want to start collecting information about what's happening in your business and tracking everything. So you want to at least start establishing a relationship with a bookkeeper. And a bookkeeper is a management accountant, by the way. That's the same. A management accountant, as I said, has bookkeeping and financial strategy. That's kind of the 2 areas we cover. So you want to establish a relationship right away with a bookkeeper and with a CFO, so that you can start planning your business. Especially in the beginning, you may have a lot of questions around sales forecasting, around how much cash you need, kind of things like that. That's what your CFO is going to help you do. I say there is no such thing as a business that's too small or too new to start getting a CFO. It just means that we're going to be doing a lot less work in your business in the beginning, but we're going to start building a relationship. So as you grow, we're ready to grow with you. I mean, I have some clients that are pre-revenue basically, or they just kind of have an idea, and we're just kind of, throwing around some ideas on paper and building your business plan right now. So, it can even be that. So
what about for business owners who feel like they can't afford something like that? Is there like software that they can start out with that's still helpful, even though it's obviously not equivalent to having a person?
Yeah, I mean, QuickBooks obviously is, they have all sorts of subscription levels. So I always recommend day one business, make sure you get a subscription to QuickBooks. I think it starts as low as like $10 or $20 a month or something like that. But even with a professional accountant like us, I mean, hopefully we may not be as expensive as you think. Like we work with small businesses all the time. That's my specialty. And I really make sure that we are able to price ourselves affordably for small businesses. So we have really affordable plans where I will hook you up with one of my team members, and you can start working together for as little as like $100 a month.
Oh,
So, yeah.
Well, I think you caught us all in the beginning with that 89% figure about increasing the odds of your success with an accountant.
Yeah, exactly.
Yeah.
I mean, the thing with business is there's certain things that you just kind of have to spend money on when it comes to business, and some things you don't want to skimp on. And I say accounting is super, super, super important. And so we try to do a good job of making it super affordable for a new business. And then, of course, as you grow, we can get more and more in depth with you, but we've already established a relationship. So it's so much easier. I wish every business came to us and it's like, please help us from the beginning. It's so much easier,
Yeah.
Was it an ounce of prevention is worth a pound of cure? That's
Yeah.
Very, very true. So, I mean, even our CFO work starts at a very, very low, reasonable fee. So,
great.
reach out to us. Happy to have that conversation. But
sure. We had one more question, just going back to the cost projections.
Yeah.
Somebody asked how you factor in the fluctuating costs of materials when you're doing all of that.
So that's a great question. That's why it's important that you go month by month. so that you can anticipate if there are fluctuations. So if you know, for example, that towards the end of the year, their prices are going to increase, maybe they've already communicated that to you, or maybe there's just seasonal increases, like you want to project that. So that's why it's super important that you do a projection month by month so you can account for all this. You can think about it ahead of time. And of course, if it's unexpected, you should be updating your projections on a regular basis, which actually I'll say at the end here. I'm going to say it again. But you should be updating this. You should never just, like, this is a working document that you need to be in constantly updating.
And your projections go on for the length of your business, right? You never stop doing them.
No. When I do initial set of projections, I say start with 24 months of projections. That's a really good runway. And you kind of just keep a rolling 24 months going. That's a really good way of doing projections. So you can see basically 2 years out. Because sometimes if you make a change in your business, it may take a little bit of time for that change to see itself through. Like, for example, if you start doing marketing, you start doing advertising today, it could take about 6 months or so before you start seeing a return on your advertising. So you want to have a little bit of a runway there so that you can see, okay, if I invest, some money today, I can predict 6 months from now that I should start seeing an increase in my sales volume as a result of that. So again, as a new business, it's probably hard for you to wrap your mind around that. For us, we know how to do it because we do it day in, day out. But as your business, as your business is around for more time, you will start to be able to predict this stuff with a lot more accuracy. You would be surprised. I will tell you, for me, I will share, I am very good at predicting what our sales are going to be at this point because I've been in business for almost 10 years. So I can, like clockwork, kind of know what our volume of sales is going to be every month because we just have so much data that we've been tracking over the years. So you want to get to the point where you can do that because then you can make really good decisions with your business.
Right.
Yeah.
Right. Okay, great. Well, I know we have another couple of minutes left. I think you had more that you wanted to conclude, right? So
yeah, just a couple of quick things. These are really short, but let's talk about forecasting cash flow. So the deal here is that profit does not equal cash. So, right, why do we have a separate section of cash? So we've already explained our sales, direct costs, and direct expenses. Doesn't that tell us how much cash we should have? And the answer is no. Just because you've sold something and fulfilled a promise does not mean that you'll get cash for it right at the moment. Sometimes you will, sometimes you won't. So for example, if you invoice your customers, you send out an invoice, they may pay you right away, or they may take 60 or 90 days to pay you, right? So the sale for the job is recognized today. You count that as a sale, but the cash comes at a different point in time, all right? And by the way, since you performed the job already, you incurred some of the costs as a result today. So you have to pay that out today. So we have cash timing differences sometimes between what we sold, what we fulfilled, and then when the cash comes in. So you have to monitor your cash flow as well. So it's crucial to understand that when that cash will be received, because you have to make sure you have enough cash in your reserves to make it through in the meantime. In fact, there are instances where companies have actually sold themselves into bankruptcy because of this. So think about it. They sold a job, they performed the job, they paid the labor, they paid the materials, they paid for everything to fulfill the job, and then they sent out the invoice, and then what? They didn't get paid, but they still had to pay everyone else in the meantime, right? So they've actually sold so fast and fulfilled so quickly that they actually ran out of cash. And ultimately, if that other customer never paid them or they defaulted or whatever, they ended up having to fold their business. It's a really, really sad thing that happens, but it happens. So you have to pay attention to what your cash flow looks like and the timing of cash, okay? So that's why we do this. So a couple of things we need to understand to project what your cash flow is going to be at every point in time. We need to make some adjustments to your sales and your costs and expenses to arrive at what your cash balance will be. So to do this, we start with your net profit and then we adjust. So typical adjustments, receivables. If you do invoicing, how many days does it take for your customers to pay you? Knowing this will help you predict when your cash will actually come into your bank account. This is why you want to use QuickBooks from day one, by the way, and do your invoicing through QuickBooks, because it will start giving you this information. You'll be able to see what your turnover is. We call it receivable turnover. How many days does it take for someone to pay me? Super important information if you do invoicing. All right, payables. How long does it take for you to pay your bills or your credit cards? Loans. If you've taken out loans, how much do you need to pay that back on a monthly basis? Equity, as the owner of a business, how much do you need to withdraw from your business on a monthly basis to pay yourself, right? You definitely want to be doing that. So you have to think about some of these adjustments here that don't necessarily show up on your P&L. So we do these kinds of adjustments here, and this is what it looks like. So we start with cash inflow. So we start with total sales. So this is what Bob sold, and then we adjust for the receivables that he sent out, the receivables that he collected on. Okay, he made an equity contribution here. He got a loan here in the month of September. And so this is what the cash looks like that's flowing into his business. And same thing with the cash flowing out of the business. These are all the expenses that he's paying for on a regular basis. All right. And so as a result, we now get to his total cash outflow. And then we add his beginning cash to that to get to his ending cash. That, as a small business owner, is super powerful information that you definitely want to keep track of month by month by month. You should know what your cash is going to be at every single month. That will help you avoid any potential issues in your business. For example, notice that here we're doing the cash forecast and we see that all of a sudden it goes negative. All right, that's a big warning sign. That means that we need to figure out today what we're going to do about that, because it's probably going to happen. So if we can, with more time we can anticipate that happening, the more planning we can do to figure that out. So maybe now what we're going to do is we're going to go get a loan from the bank or whatever and just say, hey, look, here's our cash forecast. This is what we think. Can you loan us $60,000 so we can get through to the other side of that? All right. So this is why we want to keep on top of our cash, of course. Okay. One of the most powerful aspects of a financial projection is, of course, the cash forecast. It will alert you to a possible cash shortfall. So again, we want to be able to see what is our cash going to look like. And I will tell you, as you grow your business, it will happen where you will have periods of time where you are cash flow rich. You're having a lot of cash come into your business. And then it will flip. You will have periods of time where you are spending a lot of cash because you've hit capacity. That always happens when you hit your capacity. Okay. You sell, you fulfill, and then you reach a capacity where the only way you can sell anymore is if you expand your business. And when you expand your business, you got to start spending money. But your sales don't catch up as quickly as you're spending your money. And so you end up bleeding through a lot of cash. So that's why as you grow your business, you have to keep on top of your cash flow forecast. The number one thing that will keep your business afloat. You see those statistics at the beginning? That's why a lot of those businesses collapsed, because they were not keeping on top of their cash. And maybe they started to grow and weren't ready for it. All right, so very, very important there. All right, and so that brings us to our last step, which is checking our assumptions and updating our projections based on new information. So as I've said several times, you want to make sure that you're updating your projections monthly. You make a lot of assumptions when building out your projections. So now you have to test those assumptions against reality. Okay, as you move through the year, you replace your assumed results with your actual results. Then, based on your actual results, now you can update your assumptions. Do you think that it's going to be the same? Do you think it's going to be different based on new information? What's happening here? The truth is that business is constantly changing, especially in small growing businesses. Everything changes all the time. So it's important that you update your projections with actual results every single month. And by doing that, hopefully you'll be this person here. You'll be able to ensure that your business is on track to achieving the goals that you want in your business. All right. And of course, as I've mentioned, we do offer a fractional CFO service. So if anyone is interested in that, definitely please feel free to reach out to us. We're happy to help you. No business is too small to really help start to do this type of planning here, because I know this is a lot. So that's our information there. Feel free to reach out and we're happy to chat with you. And I will turn it back over to questions.
Thank you. Thanks, Manny.
Yeah.
That was really helpful. And I think that, I mean, I know that it helped me to see the example that you gave with the slides, and basically using like Bob's as the example business. I thought that was really an interesting way to put this forth.
Good old Bob.
So I'm going to close this out because we're about at 5 o'clock. And next up on our big week for small business is the Dream Big Award ceremony. So during this event, we will be honoring entrepreneurs who have excelled this year, and we'll name our Small Business of the Year award recipient, which is always a really fun thing to watch. So you can join in the action by clicking the Event Hub link that's in the chat. And thank you all for being here today. And thanks to Manny. Bye, everyone.